Today I'm going to show you how to analyze real estate deals like a pro using the actual tool that my team and I use every single day to analyze and buy our own investment properties. Before we dive into the tool, my name is Maura. I've been a full-time real estate investor since 2018. I've flipped over 100 houses. I maintain a portfolio of 50 rental properties. I helped start a property management firm back in 2019, and I live and work in the real estate industry every day. I have developed this tool with my team that we now use every day to analyze our own deals, and I want to share it with you for free. If you want it, make sure you check it out in the link below, and let's dive into how to use it. My company, Duratus Properties, we invest in residential properties. We flip houses. We maintain a portfolio of rental properties. We have a rent-to-own line of business, and we do small multifamily deals. So I created, over the years, we've used a lot of different tools to analyze leads for the business. And so finally, I created this tool to help us streamline our lead analysis process and be able to analyze all the different types of deals we do in one tool, and hopefully a relatively easy to use format that makes it easy. And my team so far has enjoyed using this tool. It is easy for everyone to use. So I want to make it available to anyone else. So hopefully this is a tool that you can put in your real estate investor toolbox and it'll help you. And I'm going to show you how to use it today. So when you open your template, it's going to look like this. It's going to open to the directions page, which is the first tab. Then you'll see down here, there's several other tabs, and that's what I'm going to orient you to first. So, and it also describes that here on the directions page, what each tab is for and how to use the spreadsheet, as well as it has my deal criteria here at the bottom. So this is something that you can personalize to yourself in your own market. If you want, you can see down here our criteria for flips in Birmingham and Mobile, as well as rent to owns in Birmingham and Mobile, and single family rentals and multifamily properties. So you can take a look at that if you are interested, and you can kind of see a little bit about our process here. So basically how this works is we have overview tabs for single family properties, single family portfolios or groups of houses, and multifamily properties. All of these are fed by these input tabs. So basically, you're going to input all of your basic information into this single family input tab, and then it's going to populate here on the overview tab, and we're going to go over how to read that. And same thing for the portfolio input and the multifamily. They're all similar, but they do look slightly different. We're going to work through 3 different examples today so you can see how to use this and how it all works. And hopefully this is helpful for you if you want to learn how to analyze real estate investment properties like a pro. Okay, so let's start with a simple one, a single family house. So I'm going to navigate over here to the inputs tab. Okay. And I'm going to go ahead and fill out all of the basic information for a single family property that I'm considering buying as a flip. And just to save everybody some time, I went through and put this information in already. And this is actually an active deal that we've been working on for the past couple months. I saved this information from a couple months ago when we first bought it, but we actually listed it on the market a couple weeks ago, and it's under contract. And the deal panned out almost exactly how we put it in here into our spreadsheet. So that's kind of cool to see. Anyways, this is a single family house in Mobile. So first you're going to put in the address. I like to add the Zillow link. You don't need to do that. You just need the basic address. Then you're going to put the unit mix. So how many bedrooms and bathrooms? This one's a 3-1. So 3 bedrooms, 1 bathroom. Then you're going to input the square footage. This one is 956 square feet. You're going to put the lot size in square feet. whether it's tenant occupied or not. So this tab can be used to evaluate either a flip or a rental property. This one is not, it's vacant. So we're going to leave this information blank, but if it is tenant occupied, you can put that information in, which will help you later on. Then I'm going to put in a current rent. If there is a tenant in place, you can put the current rent. I am just going to put in some numbers here so that we can model what this would look like if it were a rental property, and because it's always nice to have a backup plan. If something goes wrong with a flip, could we turn it into a rental property? Let's just evaluate that as a plan B. So where did I get this rent? Well, so basically I'm just, because it's not a real rental right now, I'm just going to use the rent potential as the current rent. And if you don't know what the rent potential is for your property, you can use this tool that I have linked called Rentometer. You go over to this site, Rentometer, and basically you just put in some basic information, your address, bed bath count, building type, and analyze. And this is going to give you a decent estimate of the average and median rents for that property. So we used $1,250. It had $1,200. I did this a couple months ago, but close enough. So we'll just keep that in there for now. Security deposit, since it's not an actual rental, there's nothing right now, but in theory, it probably would be $1,250. The lease start and end date, if you have one. The asking price for the property, $140,000. Down payment is 20% of the asking price. That's what we have it modeled as, since that's usually most investor loans are 80% loan to cost. Your after repair value, this is the value of the property after you've renovated it. So the best way to get this number is to talk to your realtor team and see if they can pull some comparables for you and provide you with an ARV. If you don't have that, it's totally fine to use a publicly available source like Zillow, Redfin to find your estimate of how much this property is worth. You can simply go on Zillow and look at the Zestimate. Oh, I see they've taken a lot of these down for listings now. So a lot of the sites have now removed the Zestimate. But what you can do is you can go to the map feature that a lot of them have. Let's go like this. Let's find this guy. Okay. And great. Okay. Let's look at this area right in here. Okay, this is our property right here for sale. But then if you zoom in, you can actually go in and look at the different property values right around your property and get a pretty good idea of what the average ARV should be for your house. You can see this is our house. You can see it's on the market right now for $230,000 under contract. And that was what we estimated a couple months ago. But if you just look at the houses right around here, you see, okay, the one next to it's estimated 230, 244, 232, 208. So right in that number. So if you need to just do a quick estimate yourself, this is one tool that you can use to do that. Okay. Going back to our spreadsheet, we got our ARV. I also like to put the last sold price. You can find this on any of the publicly available sites. I think it's just an interesting thing to know going into a negotiation. You will also want to put your property taxes. You can also find that on the MLS or on sites like Zillow under your tax and purchase history. Then you're going to want to put an insurance estimate. We have insurance on this house, and because we insure all of our houses and they're pretty similar, I know that our insurance costs about $1,000 per house, But if you don't know this, you can easily call and get a quote, usually relatively quickly, from a local insurance provider, or some of their websites even they have a calculator on there and they'll give you an automatic estimate. So just find an estimate to put in there. That is an important part of your costs. Then the next thing is your repair estimate. So the best way to do this is if you're already working with a project manager, general contractor that can go through and provide an estimate for you. That is the best way to come up with this number. Then we're going to put in our exit strategy. For us, this one is a flip, but for our business, we have these different options for single family houses. We can flip, do it as a rental, or make it a rent to own property. Next thing I need to check is whether the property is in a flood zone or not. You definitely want to make sure you do this. I have the FEMA flood map linked here for you, and this is what it looks like. And all you have to do is put in your property address, and it'll show you whether your property's in a flood zone or not. Here in Mobile and Baldwin County, we have a lot of flood zones. Actually, you can see this one is really close to a flood zone. This one is really close to a flood zone, but it's not in one, thank God. So that's an easy way to check whether your property is in a flood zone. And a general rule of thumb, at least for our companies, we try not to buy in flood zones. You pay a lot of extra insurance. A lot of buyers are wary in our area of buying in a flood zone. So something important to know. Then our next area is whether we're using a certain tax strategy, like a 1031 exchange or an opportunity zone, or we're going to use cost segregation for the property. So if we have a tax strategy going into it, we can annotate that here. If you don't know what those are, you could consider taking our course, The First Steps to Investing in Real Estate. We go over all different tax strategies as well as a bunch of other stuff. But if not, really don't worry about it. Then you have the year built for your house. Okay, those are all your basic property details that you're going to need to know to analyze whether this is a good investment property. Then we have some qualitative notes that you can put in here. You can put your inspection notes, what the house is going to need in rehab. I also have a little section for the photo link. And if you have any notes from your property manager, you can go ahead and input them there. All right, so now we've filled out everything that we know, and it's time to look at what this information means to us, okay? So all that information that we input is going to automatically populate here in our single family overview, okay? Now, before we get into this, I know that some of you might be looking at this and thinking, oh my God, this looks a little overwhelming. Don't worry, it's not too overwhelming. But if you are a little bit newer to the real estate industry, in order to understand this, we need to go over a few key terms, okay? And I will link this as a PDF in case you want to download it. So the first thing that we're going to see in our overview is the IRR, or the internal rate of return. This is an estimate of the value that an asset generates during the time frame in which you own it. For all of mine, I model it as a 10-year hold, but you can adjust that for your own purposes. And essentially, the IRR is the percentage of interest that you're going to pay on each dollar that you've invested into a property over its entire holding period. And then here I have how to calculate the IRR. A benchmark, or a good general target for your IRR, is in between 18 and 20%. And then I also have a link to how to calculate IRR in Google Sheets for you. Okay, that's a little bit about what IRR is. Then the next thing that we measure in our overview is your cash on cash return. This calculates the amount of money earned over the cash invested in a property. And basically you calculate this by taking your pre-tax cash flow and dividing that by the total amount of cash invested into the project. Here I have a little link that shows you how to calculate this in Google Sheets, and a good general benchmark for cash on cash return is between 8 and 12%. So this is one of the formulas that's built in for you. Next thing is your ROI, which is like very similar, kind of the same as cash on cash return. And it's a measure of how much money or profit you are earning from your investment as a percentage of its total cost. Some people will refer to cash on cash. Some people will return. Oh my gosh. Some people will refer to cash, and you just essentially, very similar. You just take your annual return divided by the amount you invest in the property. So here's the formula. And I also have your link about how to calculate this in Google Sheets. And same as your cash on cash, a just general benchmark, good ROI is for real estate is usually between 8 and 12%. Okay, cap rate. I'm going to go over this quickly. Cap rate, we could spend more time on this, but the capitalization rate, also usually called a cap rate, is a formula that's used to estimate the potential return that an investor will make on a property. And it's expressed as a percentage, usually around between 3% and 20%. And it's often used as just a real quick way for investors to compare the risk and return profiles of different assets. As a very general example, the average cap rate for apartment buildings in Mobile is 7.46 when I'm recording this. So if you're looking at an asset, you can kind of know very quickly how it compares to the others in your market. And you calculate cap rate by taking your net operating income divided by the property value. So here's how you would do that. The formula spelled out for you. And good cap rates, solid cap rates are usually between 5 and 10%, although it can vary a lot depending on your location, the asset type, etc. And here's a link to how to calculate that formula in Google Sheets. Okay. Last thing is profit potential. So this is the amount of profit that you can expect from your project. And yeah, just basically a rough calculation of how much money you're expecting to make. And you want to subtract your purchase price and renovation costs from your after repair value. So here's how I have this built into the spreadsheet. So I have the ARV minus the asking price minus 8%. And the 8% is there to account for all of your closing costs. So that includes your 6% commissions and 2% in like closing costs, like loan fees, all the other closing costs. So that's where that 8% comes in. And that's how I estimate my profit potential for a project. For us, we have a minimum $20,000. We have a $20,000 minimum for our flips. Okay. And next up is the offer formula. So based off of all these formulas, we created a way to quickly know what we should offer on our properties. So we need to make a minimum of $20,000 on all our flips. And this formula is designed to tell you the maximum amount of money that we can offer for a house. So here's the formula that we built. We have ARV minus the 20,000. So that's our minimum profit that we need to make, minus your closing costs. So $1,000 and 8% minus your repairs. That's your offer. So here is kind of the breakdown below the formula of how I got that formula. You can check that out. And yeah, that is it. Okay, so that's all you need to know to understand what's going on here in our property overview. Okay. So let's look at what we have going on here. So all this information. So we know our down payment for our house is going to be $22,767. Our IRR, so this is our return over time. This matters a lot more for rental properties and properties that you're going to be holding over time. As you can see, it doesn't get healthy until years 9 and 10, which is expected for a flip. Your cap rate. So what you want to look at is the year 2 and beyond cap rate, because since you have to pay so much upfront for a flip, the year 1 cap rate really is not indicative of the true cap rate. You want to look at this year 2 and beyond. Our cash on cash return, this is important for us as a flip. So we're looking at 11.66. And as you might remember from the last slide, between 8 and 12% is usually considered a healthy cash on cash return for real estate. And then we have our interest rate. So this is whatever the current interest rate is at the time. Right now, we're right at 6 to 6.25%. Okay. Then we have our cash flow forecast. So this matters a lot more if this property is going to be a rental property, but I think this is helpful to model in. For us, we always like to have a backup plan. If something goes wrong with a flip, we want to know, is this going to be a good rental? And that's what this section is showing us. It's showing us our cash flow over time. So we have our annual income minus all of our expenses, minus our debt service, and that's going to give you your net operating income over time. Obviously, we're in the red in year 1 because we have a big outlay of expenses for the down payment and renovations, but then year 2 and beyond, we have relatively healthy cash flow. And finally, we're looking at our IRR, our internal rate of return. Again, this matters more for a long-term hold than a flip, but it is important to know for our backup plan how this would pan out for us. So not the best IRR, but a solid cash on cash return. Okay, so that still might seem a little overwhelming for some. This can be a helpful tool if you're analyzing a property. A lot of bankers and lenders might like to look at this. But then I like to scroll over here. This is the decision matrix that myself and my business partner use to decide, are we going to move forward with a project or not? And this is, I think, a little bit simpler to understand for most people. So basically, I'm going through as a CEO, looking at a project kind of from an operational standpoint and evaluating whether it's a good investment decision. And then my partner, Aziz, will look at it with his CFO hat on and see if it makes sense given the company's total financial picture. So for me, the first thing I'm looking at is, are we getting a good enough discount on the buy side? Basically, we want at least an 80% discount to the after repair value. And in this case, yes, we're getting it for about 60%, which is a great deal. Cap rate, right now it's reflecting the year 1 cap rate, but really we want to be looking at that year 2 and beyond is what's accurate. And over here, if we look at year 2 and beyond for our cap rate, we are right at 7%, which lines up with my target for my market. These are all my targets. Based off our market and our business model, I put in what good is for us. And that's how I can quickly go through and see if a deal is good or not. You can adjust these for your own purposes. The repair estimate, we like quicker flips these days. So we try to do them for $50,000 or less. This one's, we estimated $45,000. It actually costed less than that, around $36,000 or $37,000, which is good. The unit mix, so this house is a 3-1. I do prefer a 3-2 just because more buyers like 3-2s and up. So that's a little bit of a con. I also try to buy houses that were built after 1970 because that's when some of the building codes changed, including the prohibition of aluminum wiring. So I do prefer buying houses that were built after 1970. Square footage. We have 956. I prefer things that are 1,000 square feet or larger. This is right under that, but close enough, honestly. Target for a purchase price, we try to buy for $250,000 or less. This one is perfect range. Annual gross rent is a little bit low. Probably we would like to have it a little bit higher than where it is, but again, that's our backup plan, so it's okay. IRR is low. That's expected for a flip. Cash on cash return is healthy. We want a minimum of 10%. We're looking at 16% here, so that's great. Profit potential, we have our $20,000 minimum, and this one is going to be about $45,000. So, and then the spreadsheet will take everything into consideration and tell you what your max offer can be for the flip. So, here we could offer up to $145,600 and meet our numbers. We ended up offering $135,000. So our return is even better than what we modeled here. So operationally, this one was a yes for me, and we did go through with it. It's been a great project. Then my partner, Aziz, is looking at our overall financial picture, looking at the purchase price, down payment, our current purchasing power, so how much money we have available on our line of credit to spend, our current debt to equity ratio. I don't have that for you right now. And then our lending and funding sources. And basically, then both of us take a look and say, yes, we can move forward. We did move forward on this one. So that's a quick overview of how the single family analysis works. And the process for all the other types of properties is relatively similar. We'll work through those quickly, but it's very similar to this process. So you just basically put in some basic information, and then you get a decent little analysis that you can share with your team or your lender. So yeah, hopefully this is helpful for you guys. Let's do a quick overview of a portfolio deal and a multifamily deal. Okay, so this deal is a 7-property portfolio. This is a deal that we actually considered a few months ago, and we did not buy it. You'll see why here in a few minutes, but very similar to the single family property. You're going to go through and input all the basic property details for each property in the portfolio. In this case, we had 7. So I went through and just same as the single family, went and input all these details. Some differences here is that most of these were tenant occupied. So I did put in a lot of the tenant lease and rent information. And so I input all this quantitative data into this top part here. And then I'm also have a section for the qualitative data, just like the single family project. Here we did go through all the houses, and there was a lot of notes. Basically, the long and short of it is that these houses needed a lot of they had fallen into disrepair. They needed a lot of repair work. So that's annotated here throughout the spreadsheet with links, photo links to most of the properties. Okay, so once you've filled in all of your basic information in this area, and one other note is, so here on the right side for each property, you're putting in the details, and then over here on the left side, it's aggregating all the data for you. So it's either adding it up as a sum or averaging it so that you can take a look at the deal as a whole now over here on your overview page. Okay, so I'm going to look at the 7-property portfolio. Let's see. We're looking at a purchase price of $325,000 with a down payment of $65,000. Our IRR, again, you want to look. The IRR for this one is not great until years 9 and 10. So that's a little bit of a red flag. Your cap rate is pretty high we're looking at, again, you want to focus on years 2 and beyond. So we're looking at about a 14% cap rate, which is a little on the higher side, which is not necessarily a negative thing, just something interesting to note. Cash on cash return in year 1, not good because of the steep repair costs. We ended up estimating that this portfolio would take about $92,000 in initial repairs. So we have a negative cash on cash return in year 1, but then it gets progressively healthier over time, 13.75% all the way up to 23, almost 24%, which is really good over time. And then your interest rate. All right. Then we can take a little deeper dive into our cash flow forecast. Here, obviously, year 1 is looking rough given the down payment and the steep repair costs that we would have to pay. Then in year 2 and beyond, we start to cash flow about almost $22,000 a year, and that goes up over time. Okay, then we get here to the bottom section looking at our NOI over time. Definitely, big outlay in year 1 and then cash flowing consistently, positively well after that. IRR does not look good until years 9 and 10. Cash on cash return is actually not too bad after year 2. And yep, that's all the basic information. So then I'm going to go over here to our decision matrix and evaluate. Okay. Am I getting a good enough discount on this property? No, at $325,000, that's a little bit above our 80% target. So I would need to negotiate a little bit better price. The cap rate is, I think it was at 14%. Yes. Okay. So our target is around 7%. The cap rate is a little bit high, actually, which not necessarily negative, just interesting. Monthly cash flow is at about 1%. So that's a little lower than where we would target a 10% monthly cash flow. Repair estimate, this is what really killed the deal. It would require about $92,000 in initial repairs. And that was that's not really what we were wanting to do. We expect initial repairs, but we try to do things that don't need a complete overhaul when we take them over. Unit count, 7 units total. Average year built was 1948. That's also a red flag, given what I said about the changes in the building code that took place in the 70s. Also, the square footage, they were averaged 875 square feet, which is it's below what I like, which is 1,000 square feet. Our max price, when we're looking at portfolios, we look at things $1 million and below. So the max price, no problem there. Annual, and then because we look at things $1 million and less, we want things to cash flow, around. It really depends on the deal, but annual rent of $36,594, not bad, honestly. IRR is 9.5%. We would really love to see something almost double that. And our cash on cash return is actually not bad on this deal, but overall, given the repairs, the areas, some other information operationally, this one was a no for me. And since it was a no for me, Aziz didn't need to bother asking himself whether this fit into our overall financial picture. Okay, that is a portfolio deal. Now let's take a quick look at a multifamily deal. So this is what the multifamily inputs page looks like. A little bit more involved than the other two, but still not too complicated, I don't think. So up here, you're going to put in all of your basic property details. I chose one of the apartment complexes that I used to manage just as an example here. And this is a apartment complex in Mobile. It was 32 units. All of them were 1-1s. The average square feet of these apartment complexes was 578. There were little ones. The lot size, this property was on 2 acres. It was built in 1977, not in a flood zone. For tax strategies, because it's an apartment building, we would definitely be using cost segregation for this one. And then the amenities. So whenever you're buying an apartment complex, it's usually going to come with some amenities. So I put over here a common amenities chart that will just help you take note of what amenities are available on the property, and you just add these codes here. So here we have an open parking lot and a laundry facility. So I added those codes in to our spreadsheet. Then we're looking at our monthly income. So this is per unit. The current monthly income at the time, each unit was renting for about $600 a month. They were a little bit under rented. We'll just say that market rent was $700, and then other income monthly came from the laundry facility. All right. So that is on a per unit basis. Then we have our expenses. So this is where things get a little bit more complicated with multifamily deals. One thing you want to know is any current maintenance contracts that you'd be taking over. So I put a little table here with your common maintenance contracts to help account for all the costs. So at the time, this property had a trash collection, a landscaping, and a pest control contract. So I put all those codes in here. Then you're going to want to account for your vacancy. So in here, I have 5% modeled, which is kind of like a standard planning factor for vacancy. This also was actually fairly accurate for this apartment complex. We did not have a lot of vacancy. So, but you can up that to 10% if you want to be more conservative, or if you know the actual vacancy, you can input that there. Then delinquency is if you know the current delinquency, you can input that there, or you can model 5 or 10% in there as a planning factor. Then you're going to want to put your property taxes. Again, all of this is on a per unit basis annually, and then it based on the number of units, it's gonna multiply and annualize it for you. Okay, then we have our insurance per unit, water, sewer, gas, electric, property management, maintenance, marketing, payroll, all these normal expenses that you need to account for with a multifamily property. Then you have your big deal numbers. This was not for sale, but I just made it up that, if they were asking $500,000, the ARV is probably around $600,000, and it would cost about $100,000 in construction and repairs. So this is just a theoretical problem. I don't think it's for sale, but I just want to go through the exercise. Okay. And then down here, I'm going to put in my loan details. So if I'm getting 80% loan to cost loan, then I'm going to need to put 100,000 down with 400,000 in debt at an APR. Right now, the interest rate's pretty high. It's around 6%. Loan terms, 240 months, 80% loan to cost, our monthly payments, and our upfront loan fees. So those are normal. This is a realistic loan detail section for us, and some general notes about the repairs required for the units. All right, let's take a look at how all of our inputs are now displayed in our overview tab. Okay. So again, this is theoretical, but let's just see if this might be a good deal for us. IRR on this deal looks really healthy starting in year 3. We're looking at a high cap rate of 25%. Cash on cash return is really healthy, 36% up to, almost up into the 50s. So cash on cash return. Interest rate is good. Let's look at our cash flow forecast. Looks like we are, after year one, cash flowing right under 100,000 and up, which is pretty good. And then we're going to come down here to the bottom and look at our NOI. This graph also shows your NOI over time. Your IRR after year two is healthy. Cash on cash return is healthy. Okay, let's go over to our decision matrix. Okay, so let's see. So our discount to ARV, it looks like we're getting an 83% discount, which is a little higher than I prefer. So maybe I can negotiate that down a little bit. Cap rate, this is, again, you got to really look at year two. So it was around 25%, which is pretty high. Your monthly cash flow is at 3.8%. Ideally, in a perfect world, it'd be a little bit higher, but that's not too bad. Repair estimate, I budgeted 100,000, and just from managing the properties, they did still need a lot of repairs. So that's probably what would have killed this deal for us personally, but overall it wasn't a bad deal. You have your total unit count, average year built, average square feet. They are a little small, but we had no problem renting them when I was managing them. And price range works for us. Annual rent, $218,000 with a very healthy IRR and cash on cash return. So I think, this could be a good deal for someone if this actually existed. For us, it didn't work because of, some of these factors, but I think that with some negotiation and adjusting your strategy, this actually could be a solid deal. And that's how you analyze a multifamily pool for you. You can download it for free in the link below or on our website at Duratus Academy. Thanks so much for watching. If you found this helpful, make sure to check out some of our other free tools available at duratusacademy.com. I also host a weekly podcast called the Mastering Real Estate Podcast if you want to step up your real estate game and become a more well-rounded real estate professional. That's it for today. I'll see you in the next one, guys.